So the RBA don't have a lot of ammunition left to go. The cash rate's at 1.5%. They've made a lot of public comment previously that they probably wouldn't want to cut to zero. Now that's something that we saw in many other economies. The Bank of England, the Bank of Canada never went to absolutely zero. They left a little bit of interest rate in the economy. But clearly the RBA looking challenged and very likely, in our opinion, to cut interest rates in the latter part of this year to address some of the issue with regard to the property market, which is in decline. How effective will that be? Not hugely, in our opinion. It will be very good for confidence. It will lower the Australian dollar, we would expect. Both of those, are net benefits. But part of the problem with the property market is availability of credit rather than the price of money. The price of money, should we get, let's say, 50 basis points in cuts down to 1%, won't be passed on in full by the banks. But net, it does put a little bit of extra money in the pockets of those that are indebted. It doesn't help those that are looking for new and what was easily available credit, access back to the market. So that access to that easy flow of credit seems to have been reversed. That's not going to come back quickly. So we don't expect that complex to reflate quickly, but certainly cutting rates would help address its decline. So QE in Australia is something that the RBA have spoken about in a vast and serious crisis. Then it's a policy tool which has been very effective in other parts of the world. Clearly in Australia, if it was to be utilised, it would put a lot of downward pressure on the currency, and that would actually allow the economy to grow very quickly. It would be a pretty effective policy tool. Depending on the sequencing, if we had a huge domestic shock or probably more likely we're susceptible to a large international shock, assuming a problem in China or something of that magnitude, then QE is absolutely on the table and it's something that we shouldn't disconsider. It's been rolled out in pretty much every other Western domestic world and it's something that could absolutely arrive here as well. Well, QE would probably take the form of printing Australian dollars and buying foreign denominated currency bonds to put a lot of downward pressure on the currency. Australia has a different transfer mechanism, so our mortgage rates are not really priced directly off long-dated Australian government bond yields like they are in the United States, for instance. So we don't feel that it would have a huge material impact on pushing the price of bond yields materially lower. Having said that, it would happen at a time when interest rates would already be at or approaching zero lower bound, and so bond yields would be very compressed at that point.